Hi everyone, we're just waiting. This is John. I'm Elise Ivory. This is John Denovan. Almost got it round the other way. And we are going to talk to you about regulatory changes. So I'm just putting our screen up, and there we go. We're going to be talking about a regulatory update because there is a lot going on. I think we can all agree.
Yes.
Yes.
I mean, what we could do is go. Ooh.
Well, I think.
Oh, now have a big yawn now because when it's all very tiring, it's all coming at once, and
it's all complex. Some of it, particularly
so much at once. But anyway, let's get into it. Knock it all over.
Knock it all
and
over.
Then by the end of 2021, all the reform will be finished, and we'll be able to travel overseas.
Well, hopefully,
and then
that's the plan.
And then we can forget about all the reform again.
So today we're going to talk about best interest duty and the conflict priority rule. Conflicted remuneration, responsible lending, just a little bit about open banking, and also the breach reporting and reference checking protocols that are, proposed and will affect the industry. Oops, that's wrong. So best interest rules, very interesting.
Yeah.
We've spent quite a lot of time trying to sort out what this all means, and I think it continues.
Yes, it does continue. And at the end of the day, what change is it going to make? It's going to make change, well, when we get down to a bit later on,
yes,
because brokers won't have to do credit assessments anymore, if that comes through.
Yes, if that
it
comes
will
through.
mean that this is the test of what brokers have to do. They have to put the consumer's interest first. And if there's a conflict of interest, they've got to resolve that conflict in favour of the consumer. So in practice, what do we think will change? Not much, because good brokers should already have been doing it. But there is a fair bit of scaredness going on, a bit of fright going on, because how is it going to be regulated by ASIC? What approach are they going to do? What are they going to do? What's best?
I think the other big thing is the record keeping.
Yes, they've got to now all of a sudden start keeping your records. And we think that ASIC will probably test compliance by looking at metrics. And if you have an awful lot of loans going to a particular lender, they'll want to know, oh, that's a bit strange, particularly if that lender happens to own you. Although I noticed that one lender seems to have no longer owned some aggregators, so they've resolved that problem.
And I was just going to say that it's the record keeping, and also making sure the systems you're using aren't too set, so you can put things in them, extra bits and pieces. So other boxes and things like that. I've seen some systems where you just answer the questions and there's not a lot of room to actually add information.
Yes, well, that's going to be the most important thing, isn't it? You're going to have to write down a reason about why I selected this loan.
Yeah.
Because particularly if it's not the cheapest loan, you can take into consideration the fact that you can get a faster approval. You can take into consideration different features, and you can even take into consideration customer preferences. But if a customer comes in and says, I would really, really like to borrow the most expensive loan, a broker must explain that there are other options. Now, conflicted remuneration is a subset of best interest.
No, conflict law. We went too many slides ahead.
Oh, no, we're not going to deal with every slides, are we?
We did talk.
I mean, if we could be here all afternoon, there's better things to do. But
we'll talk about conflicted remuneration.
Yeah, let's talk about conflicted remuneration, because I like that slide, carrot, for a whole lot of little brokers, and that's the big bank, is it?
Oh, this is your slide.
Is it? Oh, I've never seen it before.
Right.
There we go. So conflicted remuneration has got a very significant potential impact for non-residential housing, not for non-home loans, if it's extended to non-home loans. Now, at this stage...
That hasn't been proposed, has it?
No,
But
bid has
been.
But bid has been, and bid has the same effect. If you've got best interest duty, you've got to be able to prove that the remuneration didn't affect. So that's good, because that's actually got a good point there. You've got two ways of looking at it. You've got the broker's perspective, where they have to be able to prove, if asked, that the fact that they chose a loan that paid a higher commission wasn't the reason they selected the loan.
Yeah.
In other words, that loan, although it paid me twice as much, whoopee, happy days, it was still the most appropriate loan for the borrowers. That's one aspect, the broker's aspect. The other aspect is the lender's aspect, and because it's a dual-edged sword here, it's a breach to pay or receive conflicted remuneration. And as I say, it's very complex for non-code, not for non-code, because not all non-code lending and all is completely out of this. So it's non-home lending. Now, if I'm classified as a mortgage broker, conflicted remuneration applies.
And then there are special rules regarding drawdown caps and volume bonuses and things like that.
Whole pain. There's also a dispute about which loans it applies to, and we're working with the MFAA to try and get clarification from Treasury about that. But a simple approach is to assume it applies to all loans lodged by a broker on or after 1 January 2021. So if I had to go and start changing my systems, I'd be saying, okay, I'm going to change my system so they apply to all loans lodged after 1 January 2021. In respect of that period, I can keep on paying up fronts and trails as I have been. I have to limit my clawback to 2 years, and I have to have a system to adjust for the drawdown cap at the end of the first year. So the drawdown cap works this way, that if I'm paying, let's say, 50 bips up front and trail is on the balance from time to time, the daily balances. So,
or even average balances.
Yeah, so the drawdown cap's never going to hit the trail if it's on the balances.
Yep.
But it can hit the upfront, and there must be an adjustment made within 3 months of the end of the 12 months if the loan was never fully drawn down during the first year, net of offset and redraw. So it's the maximum actual debt, ignoring offset and redraw. What percentage of that? You'll see on the screen there's quite a lot of slides here. We're going to be sending them out, are we?
Well, we can. Yeah.
Well, we're not going to talk to them all today, but lenders can pay the upfront based on the full amount of credit if they have a reasonable expectation that the full amount of credit will be drawn down. Now, you normally would have that expectation. And remember, it doesn't apply to line of credit, construction loans, or reverse mortgages.
Yes. We've had a question about what's our view on bid and flex commissions on auto loans.
Too hard.
And that's a very hard question.
The answer to that question could cost $500.
$500?
Or more. We could start charging legal costs for that.
That's a complex question, and there seems to be different views in the market about it and how to deal with it. But it does seem that they do conflict.
Yeah, well, our long and short view is that if you are a mortgage broker, you have to flex down to nil. Now, that's the simple answer.
Yeah.
However, there are arguments to the contrary, and but they're not they're not within the scope of today's discussion. Is that a good way of putting it?
There we go. Yes, that's a good way of putting it.
I think I've finished, and you're on now, am I? Have you got any other slides that are on my boring topic?
We talked about what a credit service is.
Yeah,
drawdown cap?
That's the drawdown cap.
Okay.
That's that, the clawback requirement.
The other one is you can't get the clawback from customers.
Yes.
It has to be, we've been putting clauses in our contracts to say, we're going to claw you back, but you cannot get this back from the customer. So there is some people who do that.
And one of the things fascinating is sort of, brokers are this sort of large group of people, supposed to be 15,000 of them. And before, there was all sorts of jumping up and down about all sorts of things. They've been very quiet about this. I haven't heard any riots in the street about the fact that clawback is going to be limited to 2 years, and when they are subject to clawback, they can't get
it back to the customer.
Pass it on from the customer.
No.
So they're obviously
not not concerned or not doing it that often.
Yes, I think that's not a problem. This is a very complex question about other payments. So just to explain the law, how are we going for time? So I'm explaining the conflict rule says that basically the starting point is I won't pay you any money at all because that might impact on your independent advice.
Yep.
And then there's a carve out. The carve out says, okay, you can provide for a credit service. You can pay for a broker doing a broker's job. And that's all you can pay for, except for a few other things here. Infrequent non-monetary benefits, less than $300. I'm not quite sure what a non-monetary benefit is, but...
lunch?
Maybe I think could call that.
Lunch?
Is that a benefit?
I don't know.
Depends who you go, depends who you go with. There's non-monetary benefits for educational training, that's pretty clear. IT support. And the last bullet point there is the credit service we're talking about. But one of the major topics which we're doing a lot of work on today is the sponsorship payments that are paid, a lot of lenders make to aggregators. So is that a conflicted remuneration or not? Is that prohibited or not? And again, we're not going to be answering that question today because it's ongoing work and discussions. What's the next slide?
No, changes to responsible lending.
Is that you?
No, that's not me. Goodness. I'll explain that change.
Looks like you.
That's not.
It is when you come in the morning.
Oh, yeah. Before my hair falls out. So I just thought, after everything we've got and 10 years of trying to work out what responsible lending was, for them to just to change it seemed, like we just wanted to say, no, we're done. We've got
sounds
enough.
like we've wasted our last 20 years. What did you do for the last 20 years? Oh, responsible lending.
Trying to work out what responsible lending was. But I think the key to this one is that there's actually not really any change. So although the media has been saying, responsible lending's been removed, it hasn't been removed. It's been rephrased as something different and restated. Responsible lending, that as we had it before, i.e. reasonable inquiries, verifications, etc., is still there for small loans, so ADI and non-ADI SACs. But for everyone else, what it's been replaced with is what they're calling the credit standards, and they're going to mirror what the ADIs have to do by the APRA standards. So we'll have hopefully when these are finalised, we will have some sort of relatively even playing field for ADIs and non-ADIs in terms of responsible lending.
So there's been some tremendous nonsense being said in the press.
Yes,
in fact, I heard it again. A question to the boss of NAB on AM this morning was, what's this about responsible lending being removed? That is the most misleading question, which the ABC keeps pushing. There is no suggestion that responsible lending is going away. The LAW law at the moment says you'll make reasonable inquiries and verifications, full stop.
Yeah.
The LAW in future is going to say much more than that.
It'll tell you exactly what you need to do.
And just because, with all due respect to ASIC, they make a nice couple of RG here, regulatory guidances here and there.
Yeah.
When the Westpac case came along, what did they say about that?
Nothing.
They said it doesn't count.
Mentioned.
It's not what the law says.
No.
So, in fact, the law for responsible lending is being expanded, isn't it?
I think it's been improved in terms of we've got more clarity now about what it actually means. These standards give you a bit more of a framework for how you actually are supposed to assess a loan.
What's the key changes, do you think?
I think there's a couple of key changes. One is that there is...
I asked the right question because it's appeared magically.
Well, I wasn't going to answer with that.
Oh.
I think the key change for consumer protection is the assumption that the loan will be unsuitable if you can't pay your rent.
Yes,
to get the
that's
loan.
a big change.
That's a big change, and recognising that we can't be throwing people out of homes, whether they own them or rent them, in order to pay other debts.
And what a sensible change.
Very sensible. And I think the other thing is, because the real problem I think we got into with responsible lending was living expenses and how you work out what someone's living expenses were. And we all got tangled in a huge mess about that. And so now what we've got...
The Wagyu steak
question. And so now what we've got is something that says, within reason, you can believe what the borrower says, but the standards as they're currently proposed also state you have to verify, that is, get a third-party source to verify income. So checking your bank statement, checking your pay slip or whatever. And you have to use some sort of third-party source to verify someone's credit risk, which I'm assuming is going to be something like, we've asked exactly what they mean by that, but I think, getting a credit report, checking they've made their repayments, they've got good history of doing the right thing. So you can't, we are protecting against no-doc loans. We are protecting against, self-declared income and all of those things that got us into a mess before the GFC.
To save time. So I have marked you on, but this slide's not about that, but that's all right.
That's okay.
We're going all right.
That's okay.
The other big one is they're recognising the different products. It's appropriate to make a different level of inquiry and verification for different products.
Yes.
Like the home loan is a pretty serious affair.
Yep.
But a personal loan of $5,000 may be less serious. And the other thing they're suggesting is you can take into account somebody's assets, so that people who are really, really, really old like me can now pass responsible lending.
Wow.
A restated responsible lending.
So
because I will be able to say, do you have any assets? I'll be able to say some. And they will be able to rely on my some assets to repay my loan. So very soon I'll be applying for a credit card.
Someone has asked where we can see the proposed standards. If they're on the Treasury website, the way I find them is by typing in Treasury responsible lending and standards, and they should come up, and you can find them there. But they're on the Treasury website at the moment. So a key change is brokers won't be required to make a preliminary credit assessment anymore. And there was a weird duplication in the law that we've had for the last 10 years. So effectively, a broker's responsible lending stuff has been replaced by their best interest duty, which is probably a more appropriate test, because the brokers, I don't think, they were always told they had to come up with their own credit standards or credit policies. No. But it made no difference. I mean,
it was impossible beyond their skills. They're small businesses, and even though they had aggregators holding their hands, they didn't have the resources to make a proper responsible lending assessment. And in any event, it was a duplication. And what an awful mess when the broker assesses you as being acceptable,
and then the lender says
no, or the other way around, the broker says, no, I can't assess you as being this loan being not unsuitable for you. Then they walk down the bank and the bank approves it.
Yes, exactly.
Horrible mess, gone.
We had a weird duplication, so that's gone. And also it means the risk to brokers is less, because now they don't have that risk that they're going to stuff up the responsible lending.
Yes, because there were big penalties. I think I added up, there were about 10 different penalties, very significant potentially, that all related to responsible lending. That's all going. So in other words, you could be fined for not making an appropriate inquiry. You could be fined for not doing an appropriate verification. You could be fined for making an incorrect assessment. Under the new regime, there's a single penalty.
Yes.
For not following your appropriate procedures or not having appropriate procedures.
Yep.
That's what the new credit standards are all about.
But responsible lending in its old form will remain for small credit, like a small amount credit, like I said, and also consumer leases. So we don't get any, they're not changing that at all. Everything to do with consumer leases is staying. And everything to do with credit guides and disclosure documents and key fact sheets is all staying as well. That's all in those same sections. Okay, we've got a question. We mentioned the question is, we're not allowed to claw back from the customer. Does this apply to unregulated credit? No. There's no rule.
Nothing we're saying about today applies to unregulated credit.
No, all only regulated, which is good to know.
I suppose just before we leave that, or just while we're talking about regulated and unregulated,
Oh yes,
one of the things in the new standards is to retain the business exemption, the temporary business exemption, which was brought in for COVID purposes. Now, this was a very confusing one. It says that if a loan is partly for, this is my words, not the actual legislation, if the loan is partly for business purposes, then you don't have to do responsible lending. The loan's still regulated by the code.
So the contract has to be
because it's the purpose of the loan is predominantly private or personal purposes. So by way of an example, I have a home loan. I'm a small business owner. I have a home loan and $300,000, and I want to use my home as security by getting a principal increase of $100,000 to get my small business to keep it going during these times, or to expand. At the moment, that would be a regulated loan tested under responsible lending. It will continue to be a regulated loan, but it does not need to be covered by the standards. In other words, the lenders can. Now, there is some confusion. As we read it, that new business lending rule will continue in the standards, but it is not free from doubt. So we're having discussions about that.
And it's proposed at the moment that these changes will take effect from the 1st of March next year.
Good luck, Charlie.
I mean, that means they have to go through the Parliament basically now. So, and the people of, the media has been reporting that some people are saying they're not, some of Parliament are saying they're not going to support them. So we just really don't know. But 1st of March is the proposed introduction date.
It'd be helpful if the media stopped misreporting it, though.
It would be helpful.
And if they said quite clearly that this is something which is good for industry and for consumers.
Yep.
I think it's particularly good for consumers.
Yeah. So another thing that's coming in 2021 is breach reporting. So the key change. Oh, this was yours, but I'll say the first thing. No,
because you're more fun than me.
Oh, I don't think that's true, but anyway. The key changes to breach reporting requirements is so we'll have a legal obligation to report NCCP Act breaches in certain cases, which I mean, we've gone 10 years now without that being legally obliged to report our mistakes to ASIC. So that's a pretty big change, except for the fact that a lot of people did it anyway.
Now, let's be clear about this. This is a different set of legislation. So
yes, this is not
this piece of legislation is before Parliament. Now, it comes back before Parliament on the 11th of December. So it's had its first and second readings in the lower house. This is very close to being LAW law, and it's about to commence. It's intended to commence on, I've forgotten the date, but let's say 1 October 2021.
Yep.
So it's a fair way away. Now, we made, MFAA made a wonderful submission, and we're very pleased to say that most of our recommendations in relation to breach reporting have been accepted. So that the regime, I haven't finished reading it all or analysing it all, but it looks sensible. Before, you had to breach report if you started an investigation to find out whether you had a breach.
That was way too broad.
Well, now that's changed. So it's quite a complex bit of work, but I think the regime that we're going to be placed with is sensible. They've also changed what kind of breaches you report. You only have to report ones that are likely to have a material adverse effect on consumers.
Yeah, well, that's sensible.
Subject to a few other ifs and buts, but basically that's the test. Whereas before, you make one little technical breach of any law, you have to report yourself.
Yeah.
Even if you were thinking, I think I'll audit the credit department and see if they're breached. Oh, I'll have to report the fact that I'm having. Yeah, it was ridiculous. Anyway, so we've got well done, Treasury. One to you.
And someone has asked, will it include breaches of bid? Yes, it will. It will include any material breaches of any of that legislation. So conflicted remuneration and bid and credit standards and all that.
The other question is who has the obligation to report?
Yes.
I can't answer that today because I haven't read that bit of the Act yet.
Yes.
It's good that I came prepared.
It's very good. Did the dobbing in provisions get through?
Don't know.
We don't know. There was also proposed that you would have to report to ASIC if somebody else did the wrong thing.
You know how much Treasury scored on their effort here?
No?
They got full marks for the other, naught here.
Okay.
Unfortunately, a very important part of this initiative was about checking on mortgage brokers when they move aggregators.
Yes.
And unfortunately, it appears that they've left out aggregators because the aggregator is not necessarily the licensee of the mortgage broker.
Yeah.
Still working through it, but the general idea was to set up a regime which was exactly the same or very similar to the one that applies to banks at the moment.
Yeah.
So in financial not banks,
This is for
financial
checking,
services for reference checking. So I'm going to hire someone to be a mortgage broker. I ask for a reference, and the previous employer says, I can't tell you because I might be defamatory.
Which is pretty defamatory in itself. Well, not defamatory, but it's fairly...
Well, potentially.
It's fairly...
And if I am going to tell you the truth, I'm worried that I might get sued. So the new regime says you have protection against being sued for defamation, and it sets out a regime for giving a reference. Fair amount of work to be done on that yet.
But that'll be welcome, I think, because that has been a big problem with aggregators and others and lenders for a long time.
Right, we're just about nearly out of time, aren't we? We've got a couple more slides then.
Do I? So the consumer data right, yeah, that's me. Consumer data right, also known as open banking. There's not a huge amount. I think this is a bit of a slow start regime. It is going to give consumers greater access and control over their data. And the aim is to allow for consumers the ability to switch products and services really quickly and easily so that we encourage competition between the service providers, so we get better outcomes. Except at the moment, it's the 4 major banks are capable of sharing customer data.
Is it useful?
Well, I think it is.
The trouble is, isn't it scary? You get all this information and then you don't notice something and you get messed up. So not, if you're doing an assessment.
Well, I think it will be useful, but at the moment there's not enough people who can do it in order for it to be worthwhile. We need all the non-ADIs and the brokers and everyone needs to be on it in order for it to work. But it is a faster and more secure way of transferring data between people. We've just got a question that says, under the Morrison government, Treasury appears to be becoming the paramount policy organisation rather than ASIC and APRA.
I think that Treasury is the department which drafts laws. It's basically what it does. I know that 20 years ago, I thought Treasury looked after
the money.
The money, it sounds like it. But they draft the laws, so the government decides what the law is going to be, and people in Treasury draft the legislation. And they do a terrific job, and they're a great team normally, and I've worked with them now for 20 plus years. And they've got some great skills there.
Yeah.
Certainly APRA can make the rules. ASIC generally can't make rules. ASIC has to interpret the law. APRA can make rules in relation to ADIs and insurance companies, but ASIC is supposed to be an enforcer.
Yeah.
And a friendly enforcer.
Yeah.
Africa, on the other hand.
I don't think we have enough time to talk about Africa,
I think we don't have enough time to talk about Africa.
And also, are there any other issues that may come onto the radar? I think that hopefully not, because we've got a lot that have come onto the radar for now. And that leads us to...
there's a bit of AML reform floating around,
AML reform,
a bit of privacy reform floating around, but
there's changes to... when I say we've got enough, I think we've got enough with all of this.
Yes.
Internal dispute resolution changes are coming. There's a new ASIC guidance on that. Some of the bits are enforceable. There will be enforceable codes coming in.
And if you can move away from credit into financial services, there's a pile there.
There's a part, anti-hawking legislation. So that's do you want fries with that approach to selling stuff?
Add-on insurance.
No add-on insurance.
Add-on insurance is something that affects the credit industry because if I'm selling household insurance, home insurance or CCI, it's potentially connected with my credit. And so there may be a prohibition on selling it.
Yes.
I'm trying to get an exception for that.
Yes.
At the moment.
So there is quite a lot, a lot happening, and I guess it's a wait and see for the responsible lending, extension of bid to finance brokers, and also if there's any changes to the conflicted remuneration, an extension of that, which we don't know anything about at this point, but we get asked a fair bit as to that one. So I think that's us out of time.